Let's jump right into this explainer, where we're looking at how massive financial empires are built, broken, and somehow rescued right from the ashes. Now, whether you're actively trading stocks or literally just keeping your paycheck in a checking account, you know the strategies these massive institutions use absolutely impact the global economy, and more importantly, they impact your wallet.
So how exactly do you build a multi-trillion-dollar bank? To really wrap our heads around the sheer scale of this world, we're going to trace the absolutely dramatic rise of Morgan Stanley, and we'll contrast that with the incredibly rugged ascent of Wells Fargo. Both of these titans somehow survived over a century of panics, world wars, and crazy technological shifts. But as you're going to see, their blueprints for success, radically different.
Just to put things into perspective, today, Morgan Stanley manages a staggering $3 trillion in assets. $3 trillion. That is an incredibly dramatic rise for an institution that the government once completely dismantled. Meanwhile, Wells Fargo recently crossed the $2 trillion mark themselves. But how they actually got to these astronomical, sky-high valuations? Total opposites. And why should you care? Because by unpacking how they amassed all this wealth, we can really start to understand the massive, sometimes super dangerous forces driving our modern financial world.
Okay, so part 1. Forging the banking titans. Let's look at their early beginnings.
The contrast in their corporate DNA is literally night and day. Up on Wall Street, J.P. Morgan Jr. and his partners back in the 1920s were so intensely powerful that people unironically called them Jesus Christ and his 12 apostles. I mean, they built this massive empire purely through elite political connections. But then, on the complete opposite end of the spectrum, you had Wells Fargo in 1852. They built this unbreakable, rock-solid trust out west by literally hunting down stagecoach bandits to protect miners' gold dust during the California gold rush. So it was this raw, physical, boots-on-the-ground trust versus elite, institutional Wall Street power. Moving right along to part 2, wars, panics, and expansion. It's all about adapting to survive.
Let's focus on the really dramatic rise of Morgan here. After FDR used the Glass-Steagall Act in 1933 to essentially shatter the monopolistic House of Morgan, you'd probably think they were done for, right? Well, from those ashes, Morgan Stanley was actually born in 1935. And this is wild. They invested just a few million of their own capital, but instantly raised over $200 million in debt purely riding on their elite brand name. By World War II, they were out there raising a massive $5 billion for the war effort. It was this incredible, rapid ascent that firmly established them as the absolute premier first-class investment bank.
Meanwhile, Wells Fargo was fighting a completely different kind of battle. They managed to survive an 1855 bank panic and the absolutely devastating 1906 San Francisco earthquake through sheer local grit. They made sure to honor every single depositor's claim, but then, during World War I, the U.S. government just completely nationalized their stagecoach express routes to help streamline war logistics. So almost overnight, Wells Fargo was totally stripped of its famous transport empire and left as just a traditional bank.
So here's the crucial takeaway. While Wells Fargo is out west aggressively expanding its retail banking footprint just to survive, Morgan Stanley actually stayed a surprisingly conservative, elite little partnership. They only wanted to do, quote, first-class business in a first-class way. But, the financial world was getting incredibly cutthroat. They had this intense rivalry brewing with hungry new firms like Salomon Brothers, who actually started stealing major, untouchable clients like IBM. And that finally forced the aging giant Morgan Stanley to modernize and actually go public in 1986 just to stay in the game.
Which brings us to part 3, the urge to merge. Welcome to the consolidation era.
As deregulation really started sweeping across the U.S. in the 80s and 90s, growing your business organically, that became way too slow. To reclaim their prestige and actually hit those strict quarterly earnings targets that Wall Street suddenly demanded, the game plan for both of these empires shifted to aggressive, monumental consolidation. It was quite literally survival of the biggest. You either had to buy, merge, or get entirely consumed by a rival. No other options.
And man, the 90s just became an absolute feeding frenzy. Wells Fargo aggressively swallowed up Crocker National and First Interstate, doubling in size over and over again, before effectively being taken over by Norwest in a staggering $34 billion megadeal. They kept that famous Wells Fargo name, sure, but the internal culture, it fundamentally shifted.
At the same time, Morgan Stanley made this massive play to tap into everyday retail finance, targeting the retail giant Dean Witter in a $10.2 billion transaction. And actually, this brilliantly illustrates exactly why Dean Witter was so attractive to a snobby investment bank like Morgan Stanley. Dean Witter's CEO, Phil Purcell, had completely turned the credit card industry upside down. He actually invented the Discover card. No annual fees, cashback rewards, making literally all its money on merchant fees. It was a total game changer. It was pumping out these huge, highly stable revenues, which Morgan Stanley desperately needed to balance out the crazy, wild swings of their trading floors.
But of course, that leads us directly into part 4, toxic cultures and crises, the true cost of all that massive growth.
Because, look, merging massive financial institutions doesn't just neatly combine bank accounts and balance sheets. It usually creates absolutely devastating culture clashes. At Morgan Stanley, the boardroom basically turned into a war zone. On one side, you've got Phil Purcell, this cautious ex-consultant from Dean Witter, who demanded total, absolute loyalty. On the flip side was John Mack the Knife, a super decisive, brutal risk-taker who grew up in Morgan Stanley's elite, ultra-aggressive culture. While Purcell outmaneuvered Mack, isolated him and kicked him out, basically surrounding himself with yes-men. And this autocratic style led to a massive exodus of top Wall Street talent. The firm was seriously struggling.
Meanwhile, over at Wells Fargo, a completely different kind of toxic culture was brewing. This new culture they inherited from Norwest relied on an impossible cross-selling quota, and they championed it internally with this almost unbelievably absurd slogan, 8 is great. They literally demanded that every single customer have 8 different financial products. 8! This pure insanity drove everyday branch employees to create millions of fake accounts just to survive that intense pressure cooker environment and, not get fired.
So let's jump back to Morgan Stanley's crisis and see how this builds to total disaster. After retired Morgan partners finally forced the unpopular Purcell out, they brought John Mack back as CEO. And Mack desperately wanted to catch up to their rivals, so he pivoted aggressively into subprime mortgages. And hey, it worked brilliantly at first. I mean, look at this. Revenues spiked from $34 billion up to nearly $50 billion in just 2 years. But then, the housing market crashed. That blind chase for market share blew up in a catastrophic $9.4 billion fourth quarter write-down. It brought the once untouchable Morgan Stanley to the absolute brink of ruin.
And Wells Fargo's toxic culture? It similarly imploded just a few years later. That whole 8 is great mantra resulted in absolute public humiliation when it came out that employees had opened 1.5 million unauthorized accounts. It led to massive initial fines of $185 million, the firing of over 5,300 employees, the total ousting of their CEO, and an unprecedented asset cap imposed by Federal Reserve Chair Janet Yellen. That cap literally froze the bank's ability to grow. So both banks let greed and ridiculous internal metrics completely destroy their foundational trust.
Which brings us to our final section, reclaiming the financial throne. How they engineered their comebacks. So despite these devastating, completely self-inflicted wounds, both of these financial titans somehow managed to engineer incredible comebacks. During the 2008 crash, Morgan Stanley really only survived by avoiding Lehman Brothers' fate. They managed to secure a massive government bailout by hastily converting into a regular bank holding company. Recognizing that the old, super risky way of doing business was totally dead, their new CEO, James Gorman, radically shifted the firm's entire identity. He pivoted Morgan Stanley away from high-stakes trading and planted them firmly into the stable, fee-driven world of wealth management, totally supercharging that move by acquiring Smith Barney. Now, Wells Fargo's cleanup required a total outsider's touch. They brought in Charlie Scharf, who was actually a protege of Jamie Dimon. Scharf was methodical and honestly ruthless in a very necessary way. He fired 55,000 employees, totally gutted and overhauled the toxic culture, and invested heavily in risk management. It took years of really painful restructuring, but his discipline finally got the Fed's crippling growth cap lifted for 2025, allowing Wells Fargo to finally truly compete again. And the results really just speak for themselves. By following the money into wealth management, Morgan Stanley engineered what is probably the most dramatic rise in modern finance. They bounced back from the brink of total, absolute collapse to become stronger than ever. They completely transformed from a battered trading house into an undisputed behemoth that manages an unbelievable $3 trillion today.
But as this explainer clearly reveals, the foundations of these multi-trillion-dollar empires are deeply, inherently tied to the culture they foster. It's really not just about the numbers, it's about the humans running the show. And with financial markets always moving in these wild cycles,
It leaves us to wonder, looking back at their histories of intense innovation, blinding greed, and near total collapse, which titan is truly prepared to survive the next inevitable crash? Just something to keep in mind the next time you see their names on a massive skyscraper or right there on your credit card statement.